Jet2 shares jumped as much as 16% on Wednesday to their highest level since January, after the company reported summer bookings up 7.1% and launched a £250 million share buyback. That move, in isolation, is exactly what investors in a beaten-down travel stock had been waiting for. But within hours of the results hitting the market, Donald Trump declared the June-Iran ceasefire was over. Tankers were under attack near the Strait of Hormuz, and oil surged more than 5% to above $78 a barrel. The same geopolitical shock that had suppressed Jet2's bookings for months and pushed its annual operating profit down to £439.6 million from £453 million the prior year had just returned on the very day the company said conditions were finally improving. What makes this day genuinely unresolvable is not simply that two opposing forces arrived at once. It is that the stock already priced in the recovery before the threat repriced. Jet2's chief executive Steve Heapy said demand had strengthened following the calming of events in the Gulf, with customers delaying travel plans rather than abandoning them. Book-to-date summer capacity is 7.7% ahead of last year at 19.9 million seats. Revenue for the year ended March grew 4% to £7.48 billion, a record. The provisional answer to why the stock surged is clear enough. The booking recovery is real, and the numbers confirm it. The unresolved question is whether that recovery holds if the Gulf conflict re-escalates, and the answer sits inside a hedging position, not inside the bookings data itself. Jet2 had hedged 90% of its full-year jet fuel requirements at an average price of $743 per metric ton as of this week's update. That single number is the load-bearing beam of the bull case. In April, the hedge was 87% at an average of $707 per ton. The company has been actively adding coverage as fuel markets stayed volatile. A 90% hedge means that for most of Jet2's flying this year, the fuel cost is locked in. Oil rising from $73 to $78 today does not immediately pass through to Jet2's cost line. The buried assumption in the surge is that the hedge makes the fuel spike irrelevant, and for 2026, over most scenarios, it largely does. What the bulls are treating as given, however, is that the remaining 10% of unhedged fuel, plus the exposure Jet2 carries into early 2027, will not become a meaningful earnings headwind if the conflict drags on. The pool makes this tension explicit. Shell reported in its own Q2 update that production at its Qatar Pearl facility, one of the world's largest gas-to-liquids plants, fell from 909,000 barrels of oil equivalent per day in Q1 to between 610,000 and 650,000 in Q2. Almost halved, because of the Middle East conflict. Shell's trading desks profited handsomely from that volatility, but for airlines, the volatility that enriches commodity traders directly raises the unhedged cost of fuel. If oil sustains above $80 and Jet2 begins layering on hedges for 2027 at elevated prices, the input cost structure of next year's business shifts materially. The paradox the consensus has not fully priced is this. Jet2's 90% hedge protects 2026 earnings with high confidence, but it is simultaneously a ceiling on how far the bull case can run, because the remaining exposure and next year's book are priced at today's elevated market. JP Morgan stated directly after the results that it will still remain a more challenging near-term earnings setup given a competitive UK outbound leisure market, the impact from the Middle East, and immaturity at recent new bases, in particular Gatwick. The hedge buys time, it does not resolve the direction of oil. Canaccord Genuity lowered its target price on Jet2 but maintained a buy rating. JP Morgan was more cautious. The same booking update produced directly opposing analyst conclusions, which is itself the signal that the market's read is genuinely split, not merely between retail and institutional holders, but between professional analysts interpreting the same data. The variable that resolves the split is not Jet2's next earnings date. It is the oil price relative to Jet2's hedge cost of $743 per ton, observed through peak summer. The EU Energy Commissioner this week said jet fuel shortages are possible if the Strait of Hormuz remains disrupted, describing it as primarily a crisis of prices and not yet a crisis of supply. But unfortunately, we cannot be sure to prevent a crisis of supply. If oil retreats towards $72, $73 as diplomatic channels reopen, the fuel hedge looks adequate, the Gatwick ramp continues, and the 7.1% booking recovery translates into operating leverage in the second half. That is the entry setup. The 16% surge had a real fundamental catalyst. The hedge absorbs most of the current spike, and peak summer is already booked. If oil sustains above $80 into August, the period when Jet2 is flying at maximum capacity against its hedged book, and Iran strikes on tankers continue, the forward hedging cost for 2027 rises. The Gatwick startup losses look harder to recover, and the re-entry of Middle East uncertainty suppresses the late booking recovery Heapy described. That is the trap. The same stock, up 16%, with the same bookings but with a fuel cost structure for the next year that the current share price has not discounted. The holder's monitoring variable is the Brent crude spot price through July and August versus $743 per ton. The watcher's entry condition is confirmation that oil has settled back below that level as ceasefire talks resume. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.